precision, data, intelligence. Welcome to this Vanguard Neural Intelligence briefing. I'm your host, and today we're cutting right through the noise to look at the structural reality of one of the market's most heavily scrutinized assets. We're diving into a definitive, data-backed explainer on Meta platforms, specifically their aggressive pivot into AI infrastructure. Look, this isn't about sentiment or feelings. This is about the hard math behind the machine.
Now, while the retail market and, frankly, the headline readers see a legacy social media company going through a really painful transition, the smart money sees something else entirely. They see a hyperscaler in the making. Meta isn't just casually pivoting to AI. They're literally rebuilding the architecture of the internet. They're out there constructing the massive physical data centers and neural networks that are going to power the next 2 decades of our digital lives.
So here's how we're going to break this explainer down. We'll start with the AI infrastructure pivot, move into the valuation disconnect, hit the technical breakdown, assess the execution risk, and finally, wrap up with our verdict and deployment strategy. All right, Section 1, the AI infrastructure pivot, focusing on human capital reallocation.
We really need to reframe the whole media narrative around tech layoffs right now. Back on May 20th, Meta scheduled a workforce reduction of about 8,000 employees. That's roughly 10% of their global staff. Now, the amateur view looks at that and sees a company shrinking, right? But the professional view? That's a surgical restructuring. This 10% slice is being aggressively excised from legacy roles to optimize operating margins and explicitly redirect that capital straight into AI workflows. Basically, they're cutting the dead weight to fuel the AI engine. It's a highly calculated structural maneuver to get the company ready for the high compute era.
Moving on to Section 2, the valuation disconnect, a generational entry. When we look at the fundamentals, there is a severe contrast between Meta's growth and its market pricing. 0.89. That is Meta's current PEG ratio. Think about that for a second. In a market where everyone, institutional and retail alike, is paying massive, inflated premiums for literally anything even adjacent to the AI hype cycle, Meta is trading at a rare discount to its own hypergrowth rate. For those who track this, a PEG ratio below 1 is a classic, undeniable signal that a stock is fundamentally undervalued relative to how fast its earnings are growing. And then consider the forward PE ratio, 16.9. This valuation exists despite the fact that Meta's quarterly revenue just climbed from $42 billion to over $56 billion in a single year. Seriously, we are looking at a company putting up hyper-growth fundamentals, but the market is pricing it like some legacy utility company in structural decline. The disconnect here is absolutely glaring. To really hammer home this fundamental argument, just look at the return on equity. It's sitting at an impressive 32.93%. What does that tell us? It proves Meta is a highly optimized machine when it comes to generating pure profit from shareholder capital. They are executing at the absolute highest tier of corporate efficiency. All of this builds out our Vanguard Neural Fundamental view. Their liquidity war chest is honestly formidable. We're talking $81.18 billion in cash and short-term investments. They generated $32.23 billion in operating cash flow in just a single quarter. Add in an operating margin of 40.6%, and you've got a fortress of a balance sheet that completely neutralizes any short-term volatility fears. Bottom line, they have to cash to fund their own revolution. They don't need external lifelines.
Section 3. The technical breakdown, the wall. Now we have to stay objective here, because while the fundamentals are soaring, the immediate price action is undeniably deteriorating. The current price is sitting at $614.23. Just above it, that 200-day simple moving average is acting like a heavy ceiling at $672.60. To any technical analyst looking at this chart, that screams structural weakness. The stock has suffered a severe breakdown and is really struggling to get back above that primary long-term benchmark.
And the momentum indicators completely confirm this bearish reality. The 10-day EMA is currently pinned down below the 50-day SMA. The MACD is negative, sitting at minus 6.51, which confirms we've got active downward pressure with zero signs of a bullish crossover right now. Meanwhile, the relative strength index is at 45.60. It's declining, sure, but not quite fully oversold yet. Plus, sentiment analysis shows severe negative retail sentiment on platforms like StockTwits, with folks pointing fingers at algorithmic pressure. Any way you slice it, the technical trend is unequivocally broken.
This brings us to Section 4, assessing execution risk, capital intensity.
You really can't look at a broken chart like that without understanding the immediate threats. $86.77 billion. That's Meta's total debt right now. To put that in perspective, just a year ago, that number was sitting around $49 billion. That is a massive increase in leverage, and it really underscores the sheer cost of playing in this hyperscaler arms race against giants like Alphabet and Microsoft. Building out the future of AI requires massive physical infrastructure, servers, data centers, cooling systems, power contracts, and none of that is cheap. And keeping that infrastructure running demands continuous, aggressive spending. Meta's quarterly capital expenditure has now shot up to $18.99 billion. Conservative analysts are starting to issue some pretty stark warnings here. They're pointing out that these skyrocketing capex costs, piled on top of over $17 billion in R&D, risk heavily cannibalizing their immediate earnings. If this AI pivot doesn't start yielding real revenue growth soon, all this spending could compress their margins violently.
One bear analyst really hit the nail on the head, noting, "A company that has to fire 8,000 people to optimize is a company struggling to balance its legacy business with its future ambitions." We have to acknowledge the sheer execution risk at play here. Pivoting your entire core competency, restructuring 10% of a massive global workforce, and taking on tens of billions in debt in a really complex macroeconomic environment, that's not a guaranteed success. It is a massive high-wire act.
Finally, Section 5, the verdict, convergence strategy.
So how do we resolve this conflict between a screaming fundamental buy signal and a very clear technical sell signal? Well, here is our deployment strategy. First off, we absolutely do not advise trying to catch a falling knife. Step 1 is to establish a small toe-hold entry as the price approaches the Bollinger lower band at $572.90. Historically, that's a zone of volatility exhaustion where the buyers tend to step back in. Then, Step 2, you only scale up your position size once the asset definitively reclaims the 10-day EMA at $616.56. Basically, we wait for that downward momentum to tire itself out, and then we buy the stabilization.
So the final Vanguard neural rating is overweight. When you look at the fundamental signal, that massive cash generation, the incredibly low PEG ratio, the high ROE, it ultimately outweighs all that technical noise, at least for any investor operating with a 6 to 12-month time horizon. Again, that target entry zone to watch is $572.90. I'll leave you with this final thought to chew on as we wrap up today's explainer. Look at the hard data. Look at the massive spending. Look at the sheer ambition. Is all of this simply the necessary cost of achieving architectural dominance in the next era of human computing, or is it the steep, unrecoverable price of massive overextension? Analyze the metrics for yourself, and as always, invest with precision.